Stocks see a fair amount of green as markets digest a range of comments from Trump, Powell ahead of a long weekend. IT and metals are the big losers, while financials, utilities see some gains. Mid-caps fare better. The Nifty bank just 1% away from fresh highs.
Private investor Warburg Pincus and the Abu Dhabi Investment Authority will invest 7,500 crore rupees in IDFC First Bank via convertibles, translating into an eventual stake of nearly 15%. CEO Vaidyanathan says he sees strong growth ahead, though the fundraise will be return dilutive in the short term.
IT stocks in focus. Wipro delivers a weak fourth quarter, guides for a decline in IT revenues in the first quarter of FY26, while Sonata Software 2 alerts on likely lower revenues from its top client. These vindicate views of analysts warning of an adverse impact of global uncertainties. IT stocks slump.
It's a roaring comeback by the bulls after the initial slump as we head into the long weekend on this weekly options expiry. You're watching Halftime Report from the CNBC-TV18 Motilal Oswal studios. I'm Hormuz Fatakia. With me is Mangalam Malu. Well, Mangalam, had there not been any action going into the long weekend, we wouldn't have complained. But looking at the screen, there is absolutely no reason to complain.
There is no reason for bulls to complain. The only thing is whether this sustains or not as we move towards, the expiry momentum, etc. as well. But the good part is that there were a fair amount of shorts in the system, and every time there was a dip, they've been, taken to the cleaners, and as a result of which, even yesterday, the second half of trade post 12 p.m. is where we saw that big up move coming by. Today, the dip was largely on account of the IT pack, which continues to be under pressure, but the IT index has recovered from the lows. Look at the banks. They've been continuously roaring. So we have HDFC Bank, which has hit a fresh 52-week high. ICICI Bank, the top contributor to the Nifty. And you can't leave telecom far too ahead as well. Two stocks from the Nifty hitting a fresh 52-week high today. We spoke about HDFC Bank. Let's pull up the intraday chart of Bharti Airtel as well. Has been a big outperformer. What's common between these two? That they are domestic facing and focused on the India market at a time when there is global uncertainty, maybe the street finding some support in these names itself. But speaking about the banking space, the big news of the day was IDFC First Bank approving a 7,500 crore rupee fundraise. Nimesh, who broke the story first on D Street Chatter, joins in with more details on this fundraise and what it means for the company going ahead. Nimesh.
Hi, Mangalam. So, as you rightly pointed out, it's a large fundraise for IDFC First Bank, 7,500 crores is what they're raising via equity, and that too from two of the largest and marquee investors in terms of Warburg Pincus, that's going to invest a sizable amount of 4,800 crores, and also Abu Dhabi Investment Authority's private equity arm, which is going to put money as well. So these are the two large entities who are putting in 7,500 crores. Post the conversion, it will mean equity dilution of close to 50%. The most important part is while the bank didn't need money at this point in time, they've still gone ahead and raised money, and that too from some large market investors. What is more interesting is, Mangalam, the fact that Warburg Pincus is re-entering into IDFC First Bank. Remember, they had a very long relationship with Vaidyanathan in Capital First, and from there in IDFC First Bank as well. Last year, they sold out completely out of IDFC First Bank, making some 8 to 9 times returns on their investments. And now they are re-entering for the next phase of growth. So what Vaidyanathan told us was the money has been raised for growth capital. So need to see as to where he puts in money. But the important news is 7,500 crores is what IDFC First Bank has managed to raise via equity from two of the large and marquee investors.
Right, Nimesh. Thanks a lot for that. And then the stock too of IDFC First Bank at one point was down around 3.5%, has seen a very sharp recovery from the lows and is now trading around the flat line, is even into the green now. Is IDFC First Bank at 63.5. Let us also listen into what the management had to say on this fundraise in an exclusive conversation with CNBC-TV18 earlier today, right after the fundraising announcement.
I think the bank needed capital. So I messaged them, I reached them directly. I told them, please, I'll be really happy if you came in. And of course, then we pitched the story. We told them how the bank is set for a phase 2 of growth, how we can create really phenomenal value in the next maybe 5, 6, 7 years. And they are long-term investors. They can see that they made a lot of money last time. So they felt excited to come again. This will have a dilution of 15%. But really, Lata, I want to just share one thing to you and to all investors hearing this program, that the main thing is that the bank has a phenomenal model. Otherwise, our operating profit could not have grown from 750 crores to 6,000 crores. like 16.4 or 5 right now, and it'll go to 18 point, close to like 19% after this raise. The thing is, Lata, that as the CEO, I have two very big responsibilities: to run a super safe bank. Super safe bank. Super safe bank is how diversified deposits are, etc., and how quality of loan book is good. All that is super safe. But capital is a very, very important part. I take that as a responsibility. And even though we were 16 plus, I have to be honest, I wanted to raise more capital. I tell them that phase one was setting up the bank, phase two is operating leverage, phase two is profits, phase two is return on equity. And I have indeed suggested to them, let me say, nobody can promise anything, but I have definitely, like in my own way, told them with a lot of confidence that they will make lots of money. So think of this year, like we had a massive turnaround in our PAT from the bank. We took it off from the loss position to profit. It was supposed to go up. It came down. It happened to us. But we believe from 26 onward for the next 4-5 years, you should expect good numbers on this bank.
Right, the IT sector is under pressure as TCS Wipro earnings disappoint. Rima joins in with more on that one. Rima, this one sector is still under the weather.
Oh, indeed. It's taking it on the chin. And now the Nifty IT index is down 25% so far this year. And it's still about 5% away from its 52-week low. Let's run you first through the news flow. Now, Wipro's under pressure because its Q1 guidance disappointed the street. Much lower than street expectations at -3.5% to -1.5%, which means your best case is revenues for Wipro in Q1 declined by 1.5%. Sonata then issued a revenue warning. They said revenues from their top client will be lower than what they were earlier anticipating. And now the street is saying that perhaps Sonata's revenues in the June quarter could decline by high single digits. Now you've got Infy, which reports numbers post-market hours. And the big question is, will they guide or will they not, given the uncertainty? And it's hard to have visibility about the second half of the year or even tomorrow. So if they don't guide, that means the uncertainty lingers on for the next 3 months. And so far, both TCS and Wipro, which have reported numbers, have missed the mark on the top line. Both of them reported a revenue decline in the March quarter, revenues falling 0.8% on a quarter-on-quarter basis. They also highlighted in their commentary that clients are turning cautious. They're taking a measured approach, at least when it comes to discretionary spending. There are instances of projects being put on hold, some decisions being delayed. So all that is hurting demand. So today you've got Infy and Tata Elxsi, but over the next few days, you will have numbers from Mastech, HCL Tech, LTI, Mindtree, and the following week you also have Tech Mahindra, Cyient, LTTS, Emphasis, Persistent, basically the rest of the pack.
Indeed, not good going for the IT names, although Sonata Software has recovered slightly from the lows of the day. It was down 12% in starting trade, is now down around about 7%. And Wipro, though, continues to maintain losses of around 5%. Let us also listen into what the management of Wipro had to tell Rima on the quarter gone by and the outlook going ahead amidst all of this global uncertainty.
There is definitely uncertainty in the market. We are hoping in the next few months, things would settle down and the clients will come back and restart the discretionary spend. I think what we are seeing more and more from the clients is the new projects, discretionary spend, when they need to start them. I think that's a delay that I'm seeing. But overall, if I look at our pipeline, which is very robust at this point in time across Americas and Europe and APMEA, and majority of those deals are also more around the cost transformation, influencing through AI optimization and improving the customer experience. Those deals to me will continue because that's going to help the client in a situation which is a lot more uncertain for them.
We've seen fixed price programs improve their productivity. We've seen acquired entities improve their profitability. We have rationalized overheads. We've also rationalized staff who are non-client facing in some of the functions and roles in G&A. So all around, it's been a very solid performance in FY25. We have said our endeavor would be to hold it in a narrow band. So yeah, 17% plus. There is pricing pressure for sure. Is this any worse compared to how it was let's say, a few quarters ago. I'm not sure how do I contextualize it, but I do see that increasingly a lot of the large deals are vendor consolidation and cost takeout. So yes, they're quite competitively fought, and therefore it does have pressure on margins.
From a hiring perspective, we have gone ahead and hired around 10,000 people from the campuses as we had called it out. We have a plan to onboard people, but we are also cognizant that we should not onboard and then not able to deploy. So we'll see how the market looks at market growth comes in the coming year. So far, we have been able to make sure that all our people actions, promotions are happening every quarter. We did a salary increases ahead of time. We are giving variable pay. The full year variable pay is around 95% to a majority of our employees. So it's been a more consistent approach from an employee expectation and aspirations point of view. For the new fiscal, our plan was to onboard about 10,000 people. We'll have to see how it goes. So far, whoever we had committed, we have onboarded everyone.
The management of Wipro, the guidance disappointing the street, the stock 5% lower. It's time to take a short break. Well, the Nifty is up 200 points now as we speak, nearing 23,650. And as we do that, here is some good news for our viewers. India's business news leader, now just a click away, and that is CNBC-TV18's all-new app, where you can get breaking news, in-depth articles, financial world updates, all of it at your fingertips. You can download the app from the Apple Store or the Google Play Store, or you can even scan the QR code that comes up on your screen. We take a short break. We'll be back on the other side. Welcome back. Now shifting focus on to Sanathan Textiles then. The stock has surged more than 24% this year so far. We are now being joined by Samir Dattani, who is the director of the company, on how tariffs may disrupt the global supply chain. Samir, good afternoon. Thank you for joining in. There have been significant developments with regards to tariffs on a lot of these on all of these textile manufacturing nations, be it Vietnam, Bangladesh, or even Cambodia or Indonesia for that matter. How do you see this situation, and how do you expect as a company to benefit from this situation?
Hi, good afternoon. So I think this situation is very advantageous to the Indian textile industry at large. The USA imports more than $100 billion worth of textiles from around the world. And currently, India has only a 10% share supplying to the US of their textile and apparel requirement. Looking at the relative situation, I think we are at a very advantageous position compared to other suppliers. China and Vietnam obviously have the lion's share of supply to the USA. So I think we are at a very advantageous situation to take advantage of this opportunity. Some of our other neighboring countries have their own internal issues, but I think India is at a very strong position to capitalize on this situation. At Sanathan Textiles, since we're into manufacturing of yarns, and we have a wide variety of yarns, we are the starting point of the textile chain. So our yarns are used for many end-use applications, whether it's shoes, bags, apparels, garments, carpets, home textiles, innerwear, bed sheets, etc. So whichever segment does well, I think we will be able to gain from the growth in demand.
Let's move away from the industry and get more specific towards Sanathan Textiles. Samir, over the last few years, your exports have been ranging between 5 to 15%. And you've constantly maintained that for you, the domestic market is where the focus lies, with exports being just an opportunistic adventure if you'll have to go. Where do you see your domestic business grow over the next couple of years? And how do you expect the export part of your overall pie to grow?
So this agility that we have in our business model, where we're able to pivot our exports between 5 to 15, even sometimes as high as 20%, has worked in our favor. Look at the current situation with the kind of tariff wars and global uncertainty. It's been great that we're able to pivot more towards our domestic demand. And the India demand has been robust. The demand has been good. Last 2 quarters, the demand has been very robust, no complaints there. And we've pivoted very successfully to place our production, our material in the domestic market and take advantage of that. In the coming years, I feel like depending on how this tariff war plays out, India is at a situation of taking advantage as far as the textile industry is concerned, and we will see increase in direct as well as indirect exports for us.
So how much would they be? Where are they right now? Because it's been a range between 5 to 15% at current period. What exactly is it? And how much higher are you likely to take it?
So right now we're at the lower end of the band at 5%, very strategically decided to keep it low because the India domestic demand and the net back is better. The turmoil in the global situation, it just makes sense for us to place our material. And there is no problem of demand domestically. In the coming years, it depends on how this tariff war plays out. I think there should be scope to improve this as long as there is a surge of demand, which will be in India's favor. And then that will also add to our netbacks and opportunity for exports.
Goes into the US because, that's the bigger buyer here because of tariffs, etc.
So it's very tough for me to sort of give a number right now, how much we'll be exporting to the US particularly. But let's not forget, we also have indirect export to the US because our yarns are consumed by contract manufacturers domestically who are then exporting their garments or shirts or shoes or bags or home textiles to the US.
What about the Punjab facility, Sameer? You had plans of commissioning it in the first quarter of the current financial year, which is the ongoing quarter. What would your contribution to the top line be once this unit is completely on stream?
So we're on track to commission this plant in the first quarter. We'll be starting in a phased manner in this quarter. In the first phase of the Punjab facility, it's designed to produce 250,000 tons of polyester filament yarn annually. And in this year, we should manage to get at least around 70% of that production.
Does that imply in terms of revenues? Because I remember when you joined during the IPO, you said that at current reckoning, you're close to around 3,000 crores. This facility, at least in the phase one, will double your capacity. And if you reach 70% utilization, should we expect 70% revenue growth in FY26 as well?
Definitely. That's what.
All right, 70% revenue growth in FY26. And what about your finance costs? Because with this facility being commissioned, your debt on books will also balloon because it will be on your balance sheet. It was close to, supposed to be around 1,400 crores with repayments of 300 crores. So is that on the cards? What's your balance sheet outlook for this year?
Similar, you're right. It will be, the debt on books will be around 1,100 crores. And we are very comfortable in terms of once the production starts to keep servicing the debt.
About margins, Sameer, you ended the first 9 months of the year at 8.6%. What do you close the year at? And is there a target that you have set for FY26? Are you aiming for double digits?
So the last 2 quarters of the last financial year have been better than the beginning. And that's why we'll end the year at a higher number than the ongoing average. And looking at what Jan, Feb, March quarter was, looking at how this quarter is going, we're definitely looking at a double-digit margin for the coming year. EBITDA margin.
All right. Double-digit EBITDA margin for the coming year, 70% revenue growth. And when does phase 2 get commissioned?
That will be a year later, after we settle phase 1.
FY27. And what is the likely revenue from that plant?
That should give us some additional revenue of about 1,000 crores once that's fully commissioned.
All right.
All right, Sameer, thank you so much for sparing time and joining us today. Wish you good luck for the upcoming year as well. The management there of Sanathan Textiles, 70% revenue growth, aspiring for double-digit margins in FY26 as well. The stock, 2.75% higher as we speak at 453. Take a short break. The Nifty still up 220 points at the 23,650 mark. Ajit Mishra of Religare Broking joins in with a chart check and some trading ideas on the other side. Stay tuned.
Welcome back. Look at the market. So big up move is what we're seeing. 23,650. It's at the day's high, 1% higher for the Nifty. A big recovery from the lows as well. And it's led by the Nifty Bank, which is about 1% away from a fresh 52-week high. The mid-cap index at an index level is a slight underperformer in today's trading session. But remember, it's been a bit of an outperformer. And the advanced decline lines tell you that there are 3 stocks, nearly 2.5 stocks in the green for each stock which is in the red right now. Important news at the bottom of your screen. SEBI's internal committee will speak about or discuss on the NSE IPO. So we'll get some data out there as well. It's a long-awaited one. Capital market plays in the marketplace are doing fairly well today. If you look at a couple of these stocks which are at, fresh 52 weeks high, we have HDFC Bank and Bharti Airtel, top contributors to the Nifty along with ICICI Bank as well. like you pointed out, these are domestic plays. So in times of global uncertainty, the street is backing these names. The Nifty Bank 1.5% away from a fresh high. The Nifty itself has seen a near 350-point recovery from the lows. So today's low of 23,300, extremely important. It's crossed past the 100-day moving average. Now we're very close, about 200 points away from March high of 23,870. Remember the big decline that we saw from January into February and then March. Thereafter, there was a recovery. We went all the way to 23,870 before falling back to 21,675 or 21,750 thereabouts itself. So this is an important level to track on the way up. Thereafter, we have the 200-day moving average for the Nifty, a little over 24,000. But today, here and now, it is the weekly options expiry. We are seeing a fair amount of put writing. So 23,400 puts are fairly active, telling you that supports has moved higher. 23,500 put writers also equally active with the market moving higher, telling you 23,450 to 23,500 is a strong support. But I'll be very interested to see how the 23,500 call writers behave, because the premium on that has surged by nearly 317%. There are still 1 crore shares outstanding out there. If the Nifty continues to trade at higher levels, then we'll obviously see these call writers covering their positions, and we can't rule out a big melt up towards the second half of trade as well, were the Nifty to sustain at these levels for the next hour or so. A lot of long positions added on JSPL, so keep an eye on the metal space. And the one stock that may enter F&O ban, yesterday we had spoken about the possibility of Irida entering F&O ban. That happened. Angel One is one that looks like may enter F&O ban given the open interest activity that's taking place out there.
And just as you were finishing your link, Mangalam, the Nifty is now nearing 23,700 now, 250 points higher. The sensex is now 900 points higher at the highest point of the day. The Nifty Bank now just 650 points away from its record high levels of 54,467. Almost there for the Nifty Bank, and it is the frontline banking stocks that are leading the rally, with HDFC Bank and ICICI Bank both hitting record highs in today's session. Ajit Mishra of Religare Broking now joins us on the show. Ajit, good afternoon. Well, the Nifty is continuing to see some recovery from the lows, but it is the Nifty Bank that's grabbing the spotlight. Is the risk reward more favorable for Nifty Bank even now as it is nearing record highs? What are the charts saying here? And couple that up with your stock recommendations as well.
Yeah, good afternoon, Homer. So yes, it's been 2 months now that we are seeing this roller coaster ride in the markets. Means what Mangalam was just sharing the data that we were at around the 23,800 levels around the February month, and we are again inching towards this area. The good part is that we have reclaimed all the major averages in the Nifty. The banking index, financials, they are leading from the front. We are almost close to the record highs. But needless to say that we have important results scheduled over the weekend, and we're going to react to those numbers on Monday after the long weekend. Stocks are already at the record highs. Yes, one can continue to anticipate that this overall momentum is likely to stay. But from the index point of view, I still feel that banking might see a breather around 54,500, the record high zone. And Nifty can surpass this 23,800, 870 area, which we have made the last swing high. So from the index point of view, Nifty looks comparatively better at current levels. Among these stock-specific ideas, since we have a long weekend ahead, look for something which is very consistent throughout this journey. Bharti Airtel, almost after 7 months of consolidation, we have seen a breakout. Stock is trading at record highs. Volumes are decent. So everything looks positive. So near-term, 20 is something that we are eyeing as a target area, with 1790 as a stop loss for Bharti Airtel. Another stock that we like from the rate-sensitive basket, we are anticipating recovery in auto counters also. So Bajaj Auto, after this recent correction, has formed a strong base now. And near-term target is 8,400. So with stop at 7,800, one can accumulate Bajaj Auto also at current levels.
Auto and Bharti Airtel are the names that he is recommending. Big move that we are seeing on a couple of these other domestic names as well. SBI is doing extremely well. Adani Ports has moved higher, and HUL too. The FMCG pack was conspicuous by its absence in terms of gains, but now that's picked up too. So everything's looking fairly good. Let's cut across to our colleague Parikshit Luthra, who's in conversation with Vijay Kedia. Parikshit.
Market regulator SEBI has called out promoters of Gensol Engineering for fraud, round-tripping of funds for personal use, and has now ordered a forensic audit. Investor Vijay Kedia warns that there could be more such cases waiting to tumble out of the cupboard. He joins us now to speak about the SEBI crackdown on Gensol and what retail investors should keep in mind, and also his views on the Indian markets amid global trade uncertainties. Mr. Kedia, thank you very much for joining us. You said that Gensol is not the only example. There could be more such companies tumbling out of the cupboard. What is your biggest worry here?
The biggest worry is what has happened and what has come out, what SEBI has caught. I think there are so many, could be many companies. I don't know about the numbers, could be hundreds of companies like this, which has actually come out with IPOs in the last 3-4 years. So biggest worry is about, obviously, every time it is only because of this is small and new investors, because they only got, they get trapped in all these things. So my biggest worry is, how to protect them.
Right. So the biggest worry is how to protect small investors. What do you think retail investors should now keep in mind? What do they should look out for when considering newly listed companies for investments? Clearly, there were several wrongdoings in Gensol at multiple levels. The board also has to be accountable at some level, the independent directors. But if retail investors are considering such stocks, what advice would you give them?
No, read these all 10 points which I had posted yesterday. Keep them handy, and before investing in any companies or even after the investment, if you find such things, then then you have to be careful. That's very simple.
Right. You've said that do not go by the hype around certain companies. You should look out for facts. So when it comes to cutting away the noise, cutting away the hype, what are certain fundamentals that one should look out for? And what are some of the warning signs that you see in the market in some of these companies that you're talking about?
No, the biggest sign, what I found, that they had become very vocal, very active on social media. As the point number 2, actually, it describes that. The moment they become very vocal, very, they try to portray themselves as they have become shareholders friendly and all. So that is one really red flag, because the good companies and the strong companies don't come out on TV channels or social media and talk every day about their doings. So this is out of those 10, this is one of the biggest red flag, I think.
Right. Too much appearance, too much focus on marketing and publicity. What do you think government and regulators need to do in order to put more guardrails before such a situation arises?
I think what SEBI is doing a wonderful job. But let me tell you, our system is such, because that is what I call autocracy of democracy. My biggest one thing I would like to pinpoint, like of course, because in our system, after SEBI is also after a regulator. No? They are not like a FBI or CBI or James Bond kind of thing they are doing. So what I think that they can expedite the issues. Like the first time this issue came to the surface, that was in June 24. Some whistleblowers, whoever brought this issue. And even now in April 25, we found that, okay, they are guilty. In the stock market, this 10 months period is too much. Even 10 days are, too long, too a long period. So I think this is what one should understand, that how this that period can be shortened. That could really help the investors.
Right. You've spoken about 10 red flags. Which are the 3 most important red flags, according to you, which you would like to share with investors here on CNBC TV18?
I think one, talking too much about their own company and too much appearance on media and all, and every time they want to raise money, and too much volatility into the share price also. As of now, while I'm talking to you and you ask for the 3 points, I think these 3 points coming to my mind.
Right. Now, speaking about India right now, and India is considered a safe haven amid global uncertainties around trade and trade wars. In the current context, which would be some of the sectors or stocks or companies which you feel most excited about?
I think tourism should do well, because government is focusing on tourism, and the way they organized and handled this Mahakumbh and all, it was just a trailer. Government has also understood now that tourism can really can help economy grow. Currently, revenue generation from the tourism sector is somewhere around $250 billion. And I think easily looking at the India, I think it can really go up to $1 trillion maybe in next 10 years. So government has also understood. So I think tourism should do well, infrastructure should do well, and hospital and hospitality should also do well.
Right. And what would be your outlook on the Indian markets overall? And this would be my last question to you, Mr. Kedia. Considering that India will also not be immune to the kind of trade wars that we are seeing, the US-China trade war as well. There are tariffs on India, even though we are negotiating a trade deal. But how do you see the trajectory of the markets, some of the concerns, some of the positives that you see along the way over the next 6 to 7 months?
I think it's very difficult to say, but what I am doing for myself, I can share this, that I think that whatever bottom market had made 15 days back, I think that could be and should be the final bottom for 2025. I think the worst is over, I think. But that does not mean that we are going to touch a new high very soon. I think market will be in a consolidation phase, maybe for next 2 years, maybe for 25 and even for 26. Now, coming to the point, this 90 days honeymoon period, which we had been granted, I think that is the golden opportunity for India to take advantage of it. We are better placed compared to many Asian countries and our neighbor and mainly our biggest competitor, China. So I think this India should take advantage of it. So it is like a blessing in disguise.
Right. And finally, there are many more startups which are looking to get listed on the stock exchange over the next few weeks and months. What advice would you like to give them in the context of what's happened with Gensol?
So just one has to be careful, as it is written, they write in the train bogie na ki yatrigan apne saman ki raksha khud kare. So investors ultimately have to protect their own things, So follow whatever I have recommended and find few more points and all, and maintain strict discipline and be organized. Don't try to become a millionaire overnight, and just follow the discipline.
All right. So be disciplined. Don't rush into growing wealth overnight. But thank you very much, Mr. Kedia, for joining us, giving your view on the SEBI probe into Gensol Engineering and your outlook on Indian markets as well. Back to you in the studios.
Thanks a lot for that, Parikshit. A very interesting conversation there with a market veteran, Vijay Kedia, for regards to Gensol Engineering. And of course, the key takeaway that we may have made a bottom for now, but do not expect new highs anytime soon is what Vijay Kedia had to say. Take a short break. More on the markets on the other side. Stay tuned. Welcome back. 265 points higher on the Nifty at 23,700 now is where we stand. So strong comeback from the bulls after the initial dip that we saw. And there you see the reversal that began from 11 this morning is continuing, and how almost 400-point recovery now from the lows of the day for the Nifty, 1.25% higher on the index at 23,700 at the highest point of the day. But the other stock that's doing well for itself today is KFin Technologies, and that's on the back of the acquisition that it had announced yesterday, and that's of Ascent Fund Services Private Limited, where they are going to acquire a 51% stake initially for around $34.5 million. And the plan is to acquire the remaining 49% stake in 3 equal tranches over the next 5 years. So in FY 28, 29 and 30, at the end of these financial years, we'll see the acquisition of 16.33% stake each by KFin Technologies, that of Ascent. Now, how is this going to benefit the company? Well, Ascent is going to help KFin with immediate access and scaled access, that too, to the global fund administration market, which currently has a revenue run rate of well over $12 billion. It also help them with required licenses and permits for services across multiple international markets, a diversified portfolio of clients, sticky and consistent revenue as well, a recurring revenue. So beneficial for KFin Technologies is what the company has highlighted. Now, Jefferies, in its note, believes that this acquisition will help the company's international expansion. It will complement its product suite, and they also have plans to lift Ascent's margins to 45%, which is what they reported in the third quarter. Ascent's margins are currently at the lower end, and They plan on doing that in the medium term. The deal valuation at 3.5 times price to sales is an attractive multiple as well. And KFin has a good track record of maintaining promoters and staff of the companies they acquire. And that is also evident from their recent acquisitions, is what Jefferies wrote in its note. However, it is cutting its estimates for FY26 slightly because of the cash outgo that is involved in the acquisition. And of course, because the fact that Ascent's margins are at the lower end currently. But they still do not see any risk of any downward pricing of the existing mutual fund contracts, and as a result they have a buy recommendation on the stock, a 1310 rupee price target, a significant upside from current levels. The stock already up 8.5% in today's session, but is down around 30% from its peak even at the current level. So good going for KFin Technologies today, 8.5% higher on the stock. By the way, the Nifty continues to move from strength to strength, 23,710 now on the index, 275 points higher. ICICI Bank, HDFC Bank, Bharti Airtel is now at a record high at almost 1,875. So great going for the three index heavyweights. In fact, Bernstein has raised its price target on Bharti Airtel to 2020 now. And it shows on the stock. Some numbers on your screen as well, but we take a look at that in as well. Indosolar reporting numbers for the fourth quarter. Take a short break. On the other side, Manisha Gupta joins in with James Anderson of SD Bullion. Stay tuned, we'll be right back.
Welcome back, and joining us on the show now is James Anderson. He's Senior Market Analyst at SD Bullion. James, hi, thank you so much for joining in. And the gold prices have been on a one-way run, $700 up in this year and perhaps $1,000 and more up in the last 12 months as well. Now that we are above $33.50 an ounce, where do you see prices heading?
At these points where you start to break out to new all-time highs, it's really hard to gauge in the short, medium term where it could go. You know, I saw Gary Wagner on Kitco News the other night doing a Fibonacci chart, and this is before the recent pop. And he was saying that, you know, with the Fibonacci chart, I posted it on my Twitter handle, he was saying the top likely could get to 3,500 by the end of May. So, you know, in the interim, you could have a run beyond 3,300, 3,400, up to 3,500 even by the end of next month.
3,500 as soon as at the end of next month. Well, who's buying this gold now, James? Because we've seen jewelry bars in India now kind of hesitant with the kind of volatile high gold prices that we have seen. But do you think that central banks, ETF investments, and that perhaps could continue?
I see it in the derivative market mostly. I think mostly what you're seeing right now is hot money coming in this trade and the momentum side. And you know, obviously, like you mentioned, ETFs and central banks. I mean, it has to be known and driven home. Most people don't understand that pretty much since 2022, 2023, 2024, central banks, especially emerging market central banks, have been buying gold at record volume. I mean, you can go back to World War II. We've never seen this amount of official gold bullion tonnage being purchased by central banks. What it reflects is a bullion over bonds trade, and that is a phase transition. That is something that's not just happening in the short run. That's something that's likely happening on the long run, where central banks are moving back toward the old allocation of having 30, 40% of their liquid sovereign wealth in outright gold bullion reserves. So that's on a longer term scale. I think people have to kind of adjust their minds to understanding that we're going back toward the old money, which is gold being the numeraire that matters most.
Oh, well, absolutely. But James, every bull run has a correction, and gold hasn't done that for a while now, while the momentum still is on the higher side. Do you see gold at some point in time get a correction, even a healthy one?
Yeah, every bull market, every one of them has to climb a wall of worry. Okay, so 3,500, if it goes there, say, at the end of May, and it recedes and it goes back and retests 3,000 or goes below 3,000, you have a 200-day moving average of gold that's at 2,700 roughly and rising. Okay, so it is possible that you could have an interim top where it goes toward that 3,500 number and then crashes back down over the North American summer, where it dips again below 3,000, because those levels, 1,000, 2,000, 3,000 for gold, they are always a wrestling match. They don't usually happen. We've already had one break above it, one test below it. And I think ultimately we may get one more test below it when it's all said and done. And that's my hunch, is that this summer we'll see that one more test below. And it's very common in the bullion bull market for gold to retest its 200-day moving average But the thing is once it's done that, generally silver goes nuts. So that's the other thing that we can discuss.
Well, I was coming to silver really, and we have seen silver kind of underperform gold in last year and in this year as well. Where do you now see silver prices by the end of 2025?
So I think the general bullish consensus in the global silver analysts, it's basically 38 to 42 has been more or less the general consensus for the year in terms of silver's high. $38 an ounce, $42 an ounce, somewhere in that area. There's other people out there who think it could go higher and faster and retest that old ancient nominal high of 50 an ounce from 2011 and 1980. What it does by the end of the year, it's not really so concerning to me because I see this more as a long-term trade. I'm holding bullion through this decade into next because ultimately I see the gold-silver ratio crashing back down to where it went in 2011. I worked, traded, invested through 2011's silver and gold bull market. This bull market that we're in blows that away. That bull market was a pipsqueak joke compared to where we're going in this one. And so ultimately, when I look out, I think in terms of 5-10 year timeframes. I don't think in terms of a 1 year trade. So if someone is going to get in this market to speculate, well, good luck because silver is absolutely volatile, and you're going to get your head handed to you occasionally in the silver market. It's one of the more volatile and dangerous markets to be trading on a short term basis. But on a longer term basis, if you do the study and you do the work and you understand kind of ratios and take the fiat currency out of the equation and use long term ratios of silver and gold versus the S&P 500, say, or silver and gold versus, you can use bonds, you can use real estate, you can use monetary base, you can use a whole bunch of variations to kind of take out the noise of the fiat currencies as they start to devalue further and further to bullion.
Well, James, as you said, that the gold and silver prices are reacting to a lot of things. As of now, for gold, it really seems like a safe haven and a hedge against various things that are happening in the international markets. What is it that you would want to watch out from here on in sense of fundamentals? I mean, tariffs is one thing, geopolitics another, the fiat currency is the third thing. And then, of course, it also is about interest rate cuts, global central banks buying. Where do you have your focus on?
So the biggest thing for me as a United States citizen is knowing that we have the largest debt in the world of all time in terms of nominal terms. And our debt to GDP is almost at the level where Great Britain was after World War II, after the war. In order for them to get out of that, they had to basically debase the pound. And ultimately, I think that's where we're headed in the United States. We have to devalue the dollar in order to meet nominally the obligations that we've made. We have 36 trillion in debt. We have a deficit this year that's probably going to be over 2 trillion. It's on its way. It's even larger than last year. We have a situation of unfunded liabilities that we have to pay on in terms of Social Security, Medicare, Medicaid, et cetera. That's depending on who you talk to, a net present value looking out of over 100 trillion to 200 trillion. It's just unpayable sums, right? And so what are the options that generally happen in history for countries and empires that are kind of fading, going from a unipolar world to a more multipolar world? Well, generally what they do is they don't default, they just devalue the currency. And so as time goes along, the world is going to realize that the dollar is no longer as good as gold. It hasn't been as good as gold for a long time, but it's going to become painfully obvious that that is the case. And all of a sudden, you're going to get a mania in precious metals, gold, silver, and even platinum later on.
All right, James, thank you so much for joining us today. Manisha, thank you for joining in as well. And as bullish comments come in, gold making new highs, what is also going from strength to strength is the Nifty, 23,740 now on the index, 300 points higher. And every time we try addressing the index, it goes up anywhere between 20 to 30 points. Another percent and a third higher now, 300 points higher, 23,750. Pull up the Nifty Bank as well. Let's see how close it has now gotten to its record high levels, because it is the heavyweight banking names that are leading the charge today on the index. 54,000 now, so just 400 points away for the Nifty Bank from its record high levels. Call time on this edition of Halftime Report. Business lunch for the next 30 minutes.